Yeah, man. So we back, man. This is Profit with Purpose, man. A space where we pretty much come together, man, and try to motivate one another financially. Where we share thoughts, Lord, share thoughts about finances. We look for ways to better steward the things the Lord has given us, and really just try to create a space that has not always been there, man. I was having this conversation yesterday for Mother's Day, and I was talking to my father-in-law and my brother-in-law, and we were kind of having some of the same conversations we're going to have tonight. And it was just like, man, it just feels so good to be in a space to talk with other like minds and grow with one another from that perspective. Because typically in our communities, we can run from financial conversations because you feel you might be judged or um, you might be in a place of lack and feel a little less than, and sometimes where in this space, it's no matter where you are, it's about where we're all trying to go. So we just open it up to be able to dissect and have good conversation and hear different strategies. Obviously, everything is not for everybody. So, you know what I mean? Like, this is not like a call with a bunch of financial advisors. So it's really just brothers sharing their journey, providing some options. And if it's something that, a person might want to take and look into deeper, we encourage everyone to do their own research and do their own due diligence to push from that space, man. But the floor is open. We typically always start with mindset because that is the foundation to any wealth journey, to any health journey, to any spiritual journey. To be quite honest, like everything starts with mindset. So I'll kick it to Rod, and we'll just let this conversation go where it's meant to be led to.
Yeah, so thank you for that, Ben. Yeah, I also enjoy this space where we just get to talk and share ideas. Uh, and with especially with any financial journey, and you hear this from all financial gurus or anybody talking about finances, start early. Uh, only because once you get the thing that you just mentioned, Ben, which is mindset. If you start earlier enough, I mean, your potential is limitless, really. Um, if you have the correct ideas early enough on, I mean, you can free yourself, I don't know, in 10, 20 years, So it's better to start early. Mindset is key. I was mentioning to JR, if every parent took their children and started at 8 years old, from 8 to 18. So they have 10 years of being given, if they give them an allowance and on a weekly basis, and then have a conversation. Okay, so this is how much you're starting with. We're going to save this much. We're going to invest this much, and then this is what you have to spend. If they could get into a habit of doing that for 10 years before they left the house, and then understanding this concept of investing, which is essentially just putting effort or resources into something and then allowing them to expand and grow. If they had uh, if these events took place in their lives and they realized or went through these things experientially, man, it would make a tremendous impact in their lives. That didn't happen for me. My father didn't know about it. I mean, he didn't have the idea to set up a plan or some sort of schedule where I'm going to impart these ideas to my children on a regular basis. We're going to come back and visit these things, so it's just a part of their lives. So, but that is the development of a mindset. Consistently coming back to an idea, revisiting it, exploring it, so it eventually becomes a part of who you are. It's the way that you process and think about things. So I just think that's tremendously important. And we get it whenever we get it, and then we just, build as much as we can after we access the ideas. So,
Good. It's like it's interesting too, because like I didn't necessarily get an allowance either, but Pops, I watched him and how he handled money.
mhm.
And that taught me more than necessarily just getting it from an allowance perspective all the time, right? Because like what I would see is him working hard, and when he gets paid, he'll put a certain amount. I remember it's like one of those water bottles, like the big joints that they be having in the doctor's office. Like he'll put, a couple pennies or a couple dollars, and you see it like stacking up over time, and like that's what he would use to buy our Christmas gifts and things like that. And like even those types of things were seeds for me because even though it's like he was putting it in the stock market or anything like that, it's a vision of seeing something grow and
Mhm.
a person save to
Mhm.
where it's like, all right, I see that. Well, how do I take this to the next level? So in my mind, I'm like, all right, I don't want to just spend it on Christmas gifts. I want to take what I save in my water bottle and try to make that grow without even touching it at all, right? So it's that there is something to like seeing the real application of how money grows and um how you save because it makes it real for a person.
No, absolutely. I agree. Uh, you know, yeah, JR. So if you guys want to, at any time you want to chime in, I don't know if you guys know how to work the 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 functions down at the bottom of the Zoom call. Just raise your hand, and then I'll call on who's ever next. Or if you have something you want to share, and I kind of want to check in with everyone too, just to kind of see where everyone is. And there were some videos that were recommended. I don't know if everybody got a chance to watch those, but I thought it, or Ben suggested them, and thought it might give us a platform on which to kind of base our discussion on tonight. But if anybody has anything they want to share or check in, feel free.
Yeah,
Well, for the go ahead, JR. That's on you.
no, go ahead. Go ahead.
No, 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 you got it. You got it. It's unspoken up.
Yeah, I was saying it's interesting. You said you saw your father doing something with some money to put it up, and you learned from that. I guess when we were growing up, I didn't see that. I didn't. It's like I know my dad went to work, my mom went to work. They came home. Remember my dad got paid on Wednesdays, and that's when they went to the grocery store every Wednesday. I remember that they come home with a so many of us, they come with a station wagon full of groceries. I guess the only thing I knew was he went to work, he got paid, and we didn't have everything. We had everything that we needed, but we didn't necessarily see any type of investing or saving. If he was doing it, he didn't impart it to us. We didn't see it. Um, and I go back to those. I remember when I got my first job. This is my lesson on money. Let me tell you something. I got my first job working at Burger King. I don't know if Jeff remembers this or not, but I was working at Burger King, and it was one summer, so I was saving money to buy my own school clothes. So when I got paid, I gave my money to my mother. She was going to hold my money for me, and I remember at the end of that summer, I went to her and I said, "Okay, I'm ready to go shopping, get my money to go buy my clothes for school this year. I'm gonna buy my own clothes and everything." Uh, and she said, "Okay, I'll get your money for you." And she gave me $60. I worked all summer, and she handed me $60. And the look on her face well, I'll never forget it. But I knew that she must have had to use that money to keep the household going. So I never said anything. I just took my $60 and went on. So from that age, I think I was in the ninth grade, 19th grade. For a while after that, I thought, man, when you get money, spend it. That was my mindset from that lesson. Spend it. So it was later that I thought, well, no, you can't spend every month, every penny you get. When I started listening to different things, but as a kid, that was the lesson I remember with money. Get it, spend it, or somebody else is going to. Yes.
That's a good perspective, man, because I think a lot of the times, like, we can develop habits, whether it for whatever reasons, right? Usually something tied to our childhood, whether it be uh you wanna be get fresh all the time, or you're trying to feel some type of need, or some people have emotional connections with food, right? To where they just got to eat at the finest restaurant, so whatever the case may be. But going back to the genesis of the conversation and mindset, like, having the awareness to take a step back to kind of see your actions and separate it from yourself to then make a change from it. That's one of the hardest things to do, because now you're attacking the root of something that is preventing you from getting to a goal that you want to get to, whether it be one day buying a house, or retiring early, or investing in stocks, or passing something down to your kids, whatever's on the docket for, whoever's listening on the call. But I think the the cognitive dissonance is when you see it and realize it, do you keep going, or is it like a adamant will to change for something better? And I think that's what leads everyone to this call, right? It's like, all right, I want to be better at this. How do I start? What type of things do I need to be thinking about? What are some stuff I can start putting in place to prevent me from making some of the same mistakes? And that's kind of where we want to kind of open the conversation. If there's anyone like that's interested in, you know, tactics, hacks, tips, or whatever, you know what I mean? So, that's kind of the root of it.
Does anybody else want to kind of check in about where they are uh, financially, or is there anything that anybody wants to share? We can kind of
Hey,
dive. Okay, I'm sorry. Who was
yeah,
that?
I'll share. You guys said something that, I can kind of fall in line with in terms of how you were raised and kind of what you saw growing up. Um, for me, lived, of course, with both of my parents. Both of my parents worked growing up in Los Angeles. It was, you know, we had our challenges. And I saw both my parents work pretty hard, and they did everything that they could to ensure that we had definitely the things that we needed, but the things that we wanted as well. But there were some hard times, and I saw my parents sacrifice and struggle a little bit. And for me, what it created in me was, we talk about mentality, it created a scarcity mentality. Or I won't say it created, but somehow I developed a scarcity mentality. And so one of the things that I did very, very early on, man, I had to be like probably 12 or 13 when I had my first job, man, is I worked at a swap meet. Man, I rode my bike miles to go to the swap meet. I just went out there hustling, asking people, can I work for him? And there would be this guy. He let me work for him. But anyway, I say all that to say what I saw my parents in the struggle. I wanted to make sure that I could relieve some of that by not having to like worry about me, because I did everything I could to make money even as a young man, a young boy actually. And I just wanted it to be easier on my family. And so I developed this scarcity mindset where I hoarded or I saved, because I never thought I thought that there would be more rainy days than not. And so I I saved, man, and I kind of hoarded for those rainy days. And um, to this day, it impacted me throughout my young adulthood because part of my mentality was I don't ever want to be in debt. And so my whole philosophy was around debt. So I worked um, and I did everything I could to eliminate debt and not maintain debt. And any debt that I did acquire, I paid it off pretty quickly. But the one thing I didn't learn early on was investing and, really, really saving, um, and then different things would come up and you have to make large expenditures, house, cars, things of that nature. And so now I feel as though I almost feel like the young kids, like I got one in college, another one about to go to college in a few years. And so I feel a sense of urgency to expedite my returns. And then on top of that, I wanna retire someday soon, but I feel like I'm still, which I don't mind, I'm still in grind mode. And I just want to find the best way possible to expedite my returns and try to assimilate some level of a non-challenging lifestyle, or living a pretty nice lifestyle rather. So that's kind of where I am, man. It's kind of, I'm in the process of learning, but I feel like me and my personality, I'm learning too much. I need to execute, and that's my shortfall. Is I think at this point is the execution.
Oh, thank you, Mike, man. Thanks for sharing that. We all kind of go through those things. So you're not alone. Jeff, I saw you had your hand up. You want to share something?
Yeah, my story is similar to JR's as well as Mike's, but kind of on the opposite end on Mike's because I was comfortable with debt. I had been comfortable with debt, I think, because I really didn't fully understand it. And one of it, what I learned early in life, not even through my parents, was I had an uncle that always talked about character. And he would tell me that your character can take you further than your mindset of budgeting, your mindset of debt, your mindset of credit or a return. It was like you could always rely on your abilities to get more, or your abilities to go get what is needed, as long as you have character to do it. And so my parents, they were very private about finance. You didn't talk about finance in my family. You were more likely to talk about sex than you were about finance. And even sex was, a little bit taboo. And in my community growing up, I grew up in a project community called Lonsdale that JR knows about. And, it was somewhat, I would say, privilege and lack, because it was community. There was a sense of, if you needed something, I remember knocking on doors, and my mom said, "Can she borrow some eggs?" My mom said, "Can she borrow some sugar?" I don't remember ever was giving it back, but that was just the mindset, is that if there was something in lack, or I would go to a friend's house, and if it's time for them to eat, hey, I'm hanging around and getting a meal. Now I had some friends, it was like, "Hey, my mom said you got to go home because we get ready to eat." So, it's like they ain't give you nothing, man. But I've learned some things. I think that until I became older and start learning about finance, my dad would always talk about saving, 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 but he didn't necessarily show me how until I got older and I understood a little bit about finance. And so that's how my life kind of similar a little bit to JR's in regards to just my mother and my father worked, but they were very private in their finance. All we knew, was that, there were things being provided from that standpoint. And we did with some lack, but at the same time, we didn't really know what that was because of the sense of love and community. And as I got older and got in college, I started using credit cards. And I was using credit cards, man. It was, to me, kind of like on the opposite side of Mike, credit cards was a tool to me. I use it as a tool. So if there was something that I really wanted, I would go ahead and borrow against it and then obviously have to pay the debt of it, through a protracted period of time. And I started actually learning how to make income by the protracted time of being in debt by using the tool. Now, fast forward as I became an adult and when I bought my first home and then about three homes, that I built three homes and I was so comfortable with debt. In fact, my wife thought I was crazy. The last home, we building homes and we're in our 50s. And so it's like, and building a bigger home than the other home, and we are, golf course and all this stuff. And debt didn't bother me. And, because I knew as a tool. And so, but I started to balance that now, because one thing about character building that I learned from my uncle that it started to reflect in my what we call a credit score, right, or FICO score. I've always had, very high credit scores. And even now, I got all these lines of credit that I can use that I don't use at all, but it's available, So I would draw from that as a tool if I needed in an emergency. And so I use finance a little bit differently. I would use other people's money basically when I start talking about debt, but then I would try to turn it around and make a return. A lot of times, the debt that I owe, the return may have been, or at least the debt may have been higher than the return, but it's the time value of money too. So I would always pay it off early or I'll do things like that. I can remember even borrowing against my 401k on my first home and I thought, man, an $80,000 home. I thought, man, I'm gonna never be able to pay this thing off. $80,000. And but I began to pay it early and paid it off in 15 years as I've learned the principle of sacrificing and things like that. Then the equity, so I doubled that equity and I bought another, built another home, obviously four times the price that I paid for that first home. And I started getting comfortable with debt. All these are mindsets, and so I didn't let anything make me feel inferior, no matter what I was faced with, because I've learned over the years that, okay, I got into this, I'm going to have to somewhat build my way out of it and be prudent. It's unfortunate that I had to be prudent many times on the back end after making a bad decision versus being prudent on the front end. And so that's what I had to learn by my own experiences. I couldn't learn it vicariously through someone else. I had to learn it on my own. But I think my greatest asset, even though I've done extremely well now, is has been my ability to have character, pay people when I say I was going to pay them. I never tried to rob, what they say, rob Peter to pay Paul. I knew some of my limitations. There's the discipline that would come in. But that was kind of my story, until I got older and start learning more, obviously in finance, because I took finance in college, I took business in college, and then I took accounting, obviously, because that's what I graduated in. And I was in accounting and still had the one of the worst lack of discipline in accounting. And I was in that pursuit. It was I was using it helping others, but I wasn't using it to help myself because of my lack of discipline. And so at the same time, I've learned some bad things as well that I thought was bad, but you can make anything work out. Just a mindset, it's just steadiness, being consistent, being disciplined, that pays off. But for me, my greatest asset has been character, the ability to follow through and to be prudent now. I mean, that's what JR talked about, being prudent now and making decisions. I mean, last year and a half, I lost like $250,000. And, it shook me a little bit, but, it was a small percentage of what I had put in, but still it kind of created some sense of, okay, wait a minute, let me be more prudent, and I became more defensive posture about investments, and I was balanced, had a balanced portfolio in regards to that. But there's some things you just can't insulate yourself from. But the key thing is, can you rebound from it? And I was able to rebound from it, make adjustments, and realize, hey, I can't just be an autopilot when I start making these decisions. I'm gonna have to till the soil. I'm gonna have to mind it. I'm gonna have to continue to put work into it, and that's why I put the value even in my marriage is, but I got to stay together. And a lot of my friends that went through, they had great portfolios, but they did not use the wisdom that comes with that. And I like the scripture said, where much is known, much is required. And so it does take more to manage the more you have. So that's my story, brother. Thanks for giving me the opportunity to share it.
Thank you for that, Jeff. Yeah, it's always good to get insight from people's journey, man. Thank you. We appreciate it. Did anybody else have anything they wanted to share or kind of check in?
No, I think that's a what Jeff was speaking to with the debt. I think it's a perfect segue kind of to some of the videos that we threw out there. Specifically the one around one of the old strategies that is often debated. I mean, I don't know if we're going to necessarily debate it, but I do think it's worth a conversation on this call just to kind of get people's thoughts around debt in and of itself. And I'm gonna share the video for those that haven't seen it. Maybe you can check it out after this call. But it, one of the guys I follow on YouTube, he's pretty savvy when it comes to like tax strategies and ways to build wealth. And like, there's this old strategy called borrow. Hold on, what is it? Is it what?
Buy, borrow, die.
Buy, borrow, die. Excuse me. And the idea or principle around it is you buy assets, you borrow against the assets, and then you die. Uh, the reason for that is you you're not taxed on debt essentially. So where more people, they want to go out and get a job that pays a higher income, or you want to sell investments when they're at their peak, of which all these things trigger tax events. So you got Uncle Sam in your pocket every time you either get paid for your job, or every time you sell stock, or every time you sell real estate, so on and so forth. Whereas the argument or strategy is, instead of selling said asset, you borrow against it so you can have a line of credit and use that to go buy new business, more stock, more real estate, so on and so forth. Of which, obviously the conversations usually stem around, number one, the discipline that it takes to enact that strategy. And number two, if you're borrowing, that means you're inquiring a payment that you have to make every month. And if you don't make said payment, whatever collateral that you're putting up gets taken. So I don't know, I just kind of wanted to raise some thought to this idea of, as Jeff would say, using debt strategically. Or and what is everyone's comfortability with debt, how you use debt, so on and so forth. I mean, I got my thoughts, but I kind of want to open it up first for conversation, before I kind of chime in and give my opinion.
Yeah, I'll start. So, you know, I, I kind of have a combination between what Mike talked about and what Jeff talked about, where I'm debt averse. I'm not really interested in holding debt, but I have been utilizing it. I pretty uh, to my advantage the past 10 years, just because I have mortgages, but I'm not the one paying them off. I have tenants that are paying off the mortgages. So I use debt to buy assets that generate income. but also this credit card strategy that Jeff talked about too. So, and you know, on one of our earlier financial calls, Abba mentioned this also, where you don't make money if you have it in a savings account. Like you, the interest rate on a savings account is almost nothing. But if you use credit cards and then pay them off every cycle, then you get rewards. Now, I know that I've gotten thousands of dollars in rewards just throughout the course of a year, depending on how much I use my credit cards. So that's one of the debt strategies that I use. I don't purchase anything on my credit card that I cannot pay off in that cycle. So I am afforded rewards as a function of using the credit card, but not carrying a balance. So I use it in that way, and then mortgages. Now, my next foray or exploration is in a home equity line of credit, which I'm in the process of getting right now. And I didn't want to get a HELOC on my own personal home, but I have found out that I'm able to access a HELOC on some of the uh, income property that I have. So I'm in the process of setting that up. But Jeff mentioned lines of credit as well, where an emergency comes up, you have access to these lines of credit where you could just write a check because you've already set it up for your bank to do that, or for them to give you a line of credit on an asset. Uh, so that's what I've been doing recently. Uh, because in my I guess my late 20s and early 30s, I just didn't want to. I had a car note, I had a mortgage that I was paying off, so my check come, then I have to give all this money, and I started to become debt averse. I paid off my house. I did that in the course of probably 5 years. I just focused in and paid off my house. Uh, And I didn't learn about HELOCs then. I wish I had. My credit union was trying to give me a HELOC, but I could only think in terms of a traditional mortgage at the time. So I didn't learn about those, but I paid off my car note too. So I didn't have a car note. I didn't have a house note. Now I'm starting to see, oh, well, I have excess funds left over if I can get rid of this debt that's calling my name every month. So those are some of the experiences I had early on, which I found once you get rid of debt, you're going to have disposable income after that. Now, what do you want to do with it? And then that goes back to mindset again. So, uh,
This question, Rod, because I'm curious now. Because I got a HELOC on my personal house.
mhm,
I was having the same conversation with my brother-in-law last night. He was telling me that the bank wouldn't let him get a HELOC for his investment property. So when you are applying for your HELOC on your investment properties, is it because your investment properties have what like is it because they're clear and free, or is it because you have a DSC loan and they're owned by the LLC? Like how I guess what's the difference between how you're setting it up versus how he was looking to set it up?
it's really the institution that you go to. Some institutions won't, because I had to call around and find one that would.
Got you.
So because at first I went to Bank of America. They're not interested in giving you a HELOC on anything except the piece of property that you live in.
Got
But
you.
Navy Federal, they have a great HELOC for investment uh, or income property. But also there's a bank here in Illinois, Illinois National Bank. They're willing to give you a HELOC on income producing property. So it really just depends on the institution.
Yeah. It's good to know. Yeah, because I'm actually looking to that process right now myself. I got a few with some equity in them.
Hmm.
Um, trying to scale up this year, so not intending to use it, but when you're doing refinance and gutting properties, sometimes you might need to tap to, finish a project or whatever the case may be. I just kind of want to have all my, options open in case. It's good to know though.
Absolutely. Yep. Does anybody else have anything they'd like to share in terms of, I guess, debt and handling debt and how you process it or think about it?
Okay, let me chime in a little bit. Abba.
Hey, Alba, how you doing,
Brother,
bro?
what's up? Hey,
I'm blessed, highly favored, deeply loved, and victorious, as always. So,
boy.
um, I I'm just like Rod. I don't like owing anybody. I feel comfortable when I pay off my loans. In fact, just in the line of what you are saying, I acquired two properties, rental properties last year, but I had to put in each of those. I put in more than 25% down payment, and then I'm working very, very hard because my strategy is to pay it off in the next 5 years. Each of those, they're expensive, not cheap. One is 340, the other one is 300. So, but I paid in. I'm now owing altogether. It's below 400,000, so that's good. So, which is what I have a strategy that I want to pay it off because they're rented at very good price, which pays off everything. It pays the mortgage monthly, the taxes, and everything. I still have leftover, but that leftover I put in to put extra so that it pays off very quickly because every $50, $100, you will find out that it goes a long way in reducing the amount of interest that you would pay. And of course, being investment property in this era, the interest rate is very high. One of it is 7.375 and the other one is 7.25. So, but every time that they call, I have these banks calling me, even the same company, because of what I do, the way I pay it off. They call me, they want me to refinance. But I realize that if I take the money, that the closing costs, because every time I ask them for closing costs, 3,000, 4,000. If I take that 4,000 and put, I'm going to save myself 4 years towards the total repayment of that. So I told them, okay, but I'm not interested, and that's basically the way. So I rather not do it that way. I do it the way that I'm just putting in extra to pay it off because I'm seeing what I want to see is that in the next 5 years, those two properties become completely income generators for to support other things that I'm doing. And the HELOC, even those companies too. I did not know that there's a restriction on that, but there are the companies that I'm with. They are willing to do HELOC if I want it, but because I have HELOC on my home that I paid off over 13 years ago, I have a HELOC, so I have access. In fact, I use HELOC in 2022 from my house, from my home here, to buy a land. That was the land was $76,000, 2.3 acres, and within 2 years I paid it off. So that was a very good thing. So taking advantage of loan, but I normally take a loan when I have a strategy to pay it off in a very short time because the gain is that if you can beat the interest, that's where you gain the most. So that's how I do my own. I manage my own debt in terms of for any debt. So that's the only debt I have. So no, I don't have any other debt. That's just a contribution. Thank you.
I don't want that to get lost. That's a bar right there. I would like um having a strategy to beat the interest, right? I
Yeah.
mean, especially back in the days where, you might have got a 2.5, 3.0 interest rate. And if you could go to the market and make 7%, 10% on your money, I mean, it makes sense, right? To borrow
Mm-hmm.
at a lesser interest rate whenever you're getting 7 to 10% on something. But it don't make sense to go to a HELOC when rates are 9, 10, 11% nowadays, and you can only make 5 to 6% on that money, right? So I think that's a very, very, very good point. In when looking at strategy and how you're plotting out, like, all right, how do I want this to look in my own personal finances? Because if it don't add up, and as you're doing your due diligence, and it's probably not wise to force it.
Mm-mm, it's not. It's not. Because if my HELOC as of now is 6.75, which is okay, but I don't use it. I rather, unless I have, unless unless I can have something like 7, because if money in the bank CD, the much I get is 3.78. That's the best CD now, which was what I do. Another way that I do, every money that I would have put in savings, I go to these banks and I do, because I just want to keep the money at the present rate of present value. So what you do, you have $10,000 that as a security money that you want to keep, leave it in a CD, 3 months, 4 months. You can make $200, $300, depending on the interest, or not 300. You can make 100 and something to $200, depending on the interest. But generally, the interest that I found now with the Fifth Third Bank, or even a Wells Fargo, is a 3.75 for that short period. And I tend to be doing that for that. In fact, last year I made over $10,000 from that short term thing, which is quite good. So, and I stay away from using my home equity line of credit because it's at 6.75. I don't use it.
Good. And go ahead, Jeff.
Question, and I know that obviously these returns, particularly well on interest and debt, is everything is annualized, right? So it's an APR, is annualized interest rates, and so that's obviously is an accounting of the time, because all interest really is the time value of money. And so the longer you have it, or the longer you borrow it, or the longer you extend it or invest it, the longer the return, or at least the more likelihood you're going to get that return, unless there's just some volatility in that process of the asset. That's why sometimes people get into a fixed asset versus some type of variable asset. But my question is, when some of the intangible things, like I just got um, a new tax assessment value on my home of $500,000. Now, it came out of nowhere, right? And we're seeing in some of the areas that are being heavily populated or people are migrating, particularly Tennessee, no state income tax. And so the infrastructure is lacking. So now the way they balance the act is they just charge you more on real property. Obviously, if you're a renter, maybe the renters will charge, eventually they catch up and start charging more rent because everything kind of trickles down from the top. So, I don't own rental property. I thought about getting into it. I said, well, let me see about my time and what I have to invest to manage it, unless I hire a manager to manage the properties to make sure that everything is up and up. Now, I can do all my own, checking their credit, making sure that they are, have the ability to pay and the capacity to pay and all those things. I can be very prudent, but then just the management of the asset. But my question is, how do you guys balance when you have those intangibles, like if you have a new tax assessment value on real property and they go up at a certain point in time, do you change your rent structure to account for that? Do you have time to adjust when you have, I mean, mine obviously is a pretty high amount, $500,000, but again, how would you, or what is your strategy on those type of situations that would appear to be a little bit intangible and somewhat maybe unpredictable when it comes to those type of things?
Do you want to speak to that, Ben?
Yeah, I'll go first, and then you can. I mean, for me, it happens. Like it does. Like I typically pass it on to the tenant. If I'm being completely honest. However, there's also a marketplace point too, right? Like to where if you've already kind of high on rent and you start passing it on to the tenant too much to where you start outpricing the market, For me, I started looking at, all right, is this an asset I still want to hold, right? Because I mean, the numbers aren't really the margin on the numbers are getting so slim that it doesn't even make sense to kind of hold this asset unless the appreciation in set neighborhood or set condominium, wherever, HOA, whatever, is outpacing like the rest of the, anywhere else that I would look to buy, to where I would eat being stagnant and not cash flowing on the monthly to catch the appreciation on the back end of it. So, for me, I look at it from two perspectives. Like, what's your monthly income? And then what's your cash on return income in totality? Meaning, like, if I put, let's just say, for sake of numbers, if I put 15,000 down on a $75,000 property, but I know that neighborhood, because of the growing area, is going to be worth right around 150 in 5 years, I'll eat a little cash flow on the monthly because I know I'm gonna double my money in 5 years' time. So,
Hmm.
I look at it from all angles from that perspective.
Good to know. That's a good answer.
So yeah, I've dealt with that too. There's one piece of rental property I have in particular. Taxes are a little higher than you know, I guess than are comfortable for me. Uh, well, and I won't say that because I'm still able to pay off all my expenses, taxes, insurance, mortgage, and still save when events show up and I need to make repairs or hire a contractor. So I'm still in pretty good shape. And I was able to get the piece of property and then add value to it, where the mortgage came in at a certain place where I could charge what I needed to charge and still save enough and pay off all my expenses too. And what I've been fortunate enough to do is price a little bit beneath where the market is, which Ben mentioned that. And because of that, I'm able to get a lot of loyalty from my tenants because if they move, it's going to cost them more than what they're paying now. So I've been fortunate in that. And then, you know, through through the last 6, 8 years, I've kind of seen this unfold. And so now my goal is to always purchase my rental property at a price point where I can charge enough money to pay off all my expenses and do some saving and be just below where the market is. So um,
Hmm.
it's a strategy that's working really well for me right now. I've also been able to address the mortgage and pay it down faster. So that's going really well for me. So, but I definitely understand the like when when I get the tax assessment every year, I kind of cringe a little bit because I know my taxes are going to go up. But I've positioned myself with price points and then what I've been able to do with the mortgage uh, before it reaches its maturity date to kind of pay that down and just be in command of it in that way.
Hmm. So do you pay extra into your mortgage monthly, or what do you do?
Yeah, well, there was a time in there, I guess. So my mortgage was 10 year. I had a 10-year mortgage. And I guess
A 10-year
around,
mortgage, you don't need to.
I'm sorry.
No, I said 10-year mortgage, you don't need, there is nothing that you could do to reduce it to make a much impact. It's
No,
a 30-year mortgage that makes impact if you pay in extra.
yeah, nah. Well, I mean, I was so I'm 8 years into this mortgage now. I could pay it off tomorrow if I wanted to because I have enough savings, but I was able to pay it down enough uh to where I'm just in super command of this mortgage. I mean, So it did make a difference, but I got a part-time job and started doing that. So it wasn't just the income coming off the property. I decided
I
to
know.
focus in and pay this mortgage off. So
Okay.
yeah, but it's right now. I definitely get it. 30-year mortgage, the lower, or if you get a 30-year mortgage, the payment will be lower. Then you can kind of pay down the principal, and you won't get charged as much interest. So no, I get where you're coming from. I was just able to. Uh, I just got fortunate and focused and decided to really do something with uh, just getting out of debt just because I'm debt averse, or those late 20s and early 30s caused me to be debt averse. So
Okay. It's good to hear.
I want to circle back real quick. I'm gonna share. No, Abba was talking about CDs. Uh, One of my safe like money holders is a SPAX fund on Fidelity. It's very similar to a CD, but you don't have to lock your money in for 30, 90, 6 month, year time frames. Like if I wanted to pull my money out tomorrow, I could. And it still gets you that anywhere between 3.25 right now and 3.75 interest on your money. What it is, it's a mutual fund that invests in government treasuries. So it's pretty much just passing the coupon to whoever owns the money market. But it's a nice, safe investment that produces good income. I call this my same as cash account, really. But something to definitely look into without having to necessarily lock up your money for extended periods of time. So, you can stay pretty liquid while also getting a little interest as well.
okay, what's the
I
interest
need that
rate on this?
information. I need that information, Ben.
I
That's
just
good
sent it
one.
to the I just sent it to the chat. The ticker is
Okay.
SPAXX.
Okay. I'll check that.
Yep. Hey, but
I'd
I'm not
love
a
that.
financial advisor. Do you do the due diligence and your research?
No, I'll do my due diligence. Yeah, because it's
So,
something that because I know they have it. They have the same thing at Wells Fargo, but I did not look into that. In those days, but now it is 3.25. You log in for 1 year, as long as you have the threshold. You have the threshold of $25,000. You can get that interest. If anything above that, you can take your money out without any penalty, but it has to remain at 25,000 before you can get that 3.25 for 1 year.
Mine's the
yeah.
same way. That threshold is one of the kickers. So Ben, what you're saying is definitely unconventional from that standpoint, but maybe because of the government security backing on it. But I'm definitely going to look into that.
Yep, word for look. I put my father-in-law on it. He's like the thing is he's closer to retirement. So like he's not as risky anymore. So when he came across it, he was like, yeah, he was pretty happy. It's kind of what he was looking for. But now this is a good conversation, man. This is exactly what, I don't want to delve into tonight. Like this is allowing us to kind of uncover some things and get some strategy. I know we got about 12 minutes. Rod, you got anything specific you wanted to hit before we get out tonight?
Man, I can't think anything right off the top of my head. I think the conversation has been good so far. Just in terms of, again, mindset, but this issue of debt and how to handle it, those kinds of things are super important when it comes to building your finances. So I think we've covered some pretty important topics tonight.
Yeah, we can go one or two places. We can talk about the market in general, just kind of where we see things going, or we can do a round robin for like accountability. I know for the regulars, what we've kind of started to do is um, allow ourselves to kind of vocalize what are some of our short-term goals and long-term goals. And every other week, we kind of come on and give updates so that we're holding ourselves accountable and holding our brothers accountable too, to make processes or make progress towards set goal. So I think that's honestly, it's been really good for me because it's actually pushing me to push some stuff forward that I had kind of been, just kind of letting, work the way it worked. Because I like to come back to this call saying, "Hey, I made some progress." So, I think it's a good way to hold each other accountable for sure.
No, absolutely.
So, I mean, which one would you prefer? You rather go round robin accountability or just talk overall markets? Because I mean, it's a lot to talk there too. Oil, Iran, just to go a lot of different ways with that.
Yeah, I maybe the market might be best. I mean, I can definitely talk about my accountability because I was able to meet with my guy, and I do have some assets that I'm focused in on now, and just doing a little research before I pull the trigger. But I think the market discussion would be good too, just because, I'm of the mind that a recession is coming, but the market just is not supporting that. Because the stock market just keeps going higher. And I mean, we do have inflation, but I don't see, I'm not sure if it doesn't seem like, I don't know, people are being challenged in the job market too. I mean, I know some of that's going on, but I don't see indicators that a recession is coming forthwith, or I mean, it just doesn't seem like it's happening. So I'm open to discuss the market too. I don't know what you wanted to
Man,
lean toward.
for me, like I like to follow the leaders, right? Like the real leaders. You look at guys like Warren Buffett, who
Hmm.
has Berkshire sitting on 300 billion in cash,
Hmm.
right? And he's still selling stock to try to get more cash because he vocalized he believes that a through pullback is coming. And I mean, he's saying a deeper one from what we seen in February, right? February was 20% pullback. So sounds like he's expecting 50%, maybe even more, like a once in a lifetime type of buying opportunity. Um, Me personally, I don't know, man. It's so like you said, man, it's way too much optimism for what I feel day to day.
Hmm.
And I know oftentimes like traders, investors, they can be out of touch with reality because they live a different type of lifestyle. But like the people I have conversations with, like people are struggling. Like gas is about $5 a
Right.
gallon right now.
That's
You
right.
know what I mean? Like inflation is still crazy high and income ain't matching these new prices of goods, services, and food.
I agree.
Like not to mention housing. So like there's a big disconnect in the market, in my opinion. And when we start having them type of disconnects, like it just makes me wary because I do think a crash could happen. But the flip side of that is also they won't let a crash happen
Right.
because the government, you know what I mean,
Yeah.
like will just print more money. It's not
Yeah.
like it's tied to anything anymore. It's not like, oh well, we got to get some more gold in order to print money. Like, no, they just go into a booth and hit a button
Oh.
and then the money becomes the money. Like, I'll give a perfect analogy I heard today of kind of what's happening is that you go and get a mortgage for a house in 1990, right? And the mortgage on that house is $500. And that's going to be your payment for the most part for the next 30 years. Well, what's happening is you jump from job to job to job to job and like kind of revved up the income in the house so much to where you used to make 50,000, but inflation has boosted you to 100,000 income and your payment is still the same. So it feels like your payment is easier, but you're only getting paid more because the cost of everything else is going up. And that's what the government is basically doing with its debt right now. Like we pay 6%, we pay more in debt interest as this nation than we do in war, like defense.
Hmm.
Like that's crazy.
That is
That's
crazy.
like saying you got more credit card debt. You paying more in credit card debt than your mortgage. Like that's a problem. So like if I came to you and told you, hey Rob, like man, I pay $3,000 a month in credit card debt and my mortgage is 2,500, you look at me like I'm a bad money manager.
Mhm.
Well, guess what? That's our government right now.
Right. That's right.
So I don't know. I'm just wary. I'm paying attention because there are some tea leaves that need to be read.
Mhm.
But overall, um, I'm still investing. I haven't pulled into cash yet, but I
Right.
can't say I won't by the end of the year.
Hmm.
I don't know.
And so, it's interesting that you say that, man. That's another reason I want to get this HELOC up and running because I can pull $20,000 I could just write a check, $20,000 if I want to get into if some opportunities show up, and my payment monthly will be $200, and then I can just
Mm-hmm.
address it as, pay off more whenever I want, and then I could use my rental property to really do that. So, uh, that's another reason I want to really get this HELOC tool tightened down in the way that I want. So when opportunity does show up in the way you're talking about, it'll be easy for me to access it. But I'm invested too. I haven't really sold off like I've been thinking about doing, uh, just because I'm in stocks that I trust. I want them to fluctuate because I can buy more at that point. So, uh, but yeah, no, I hear you, man. I'm looking for opportunities too, and I'm with you. I want to follow the leaders too, and it does seem like everyone is divesting and getting into cash. So when the opportunity does hit, they're just gonna, gorge themselves with money, you know. So
Okay,
Yeah,
James,
I think it's interesting too. Um, Obviously I'm on the other side in terms of the regulation aspect of it, and there's been quite a bit of deregulations, and I can remember when I used to examine in the oil and gas industry and how the deregulation gave it a false sense of security. And I can remember the savings and loans, the deregulation gave it a false security. Then I can remember even sometimes in terms of just the reliance on some, at that time, it was their artificial intelligence. It was they're very liberal in that aspect. Also in investments, there's a time where bankers were taking securities and splitting them and calling them tigers and selling off the interest and the principal and making investments on one or the other. Didn't understand it, but because of the high return, they were chasing it. But I will tell you, in the 30, 40 years in the industry that I've been in, everything is cyclical and it is going to burst. I guarantee you that. That's just the balance of scale. It has never defined or done anything different. As the word would say, there's nothing new under the sun. The question is when. Um, right now, there's so much falsehood and the reliance on the indicators. They're not the real indicators. And so if you're relying on those indicators, you're really gambling. And that's okay because you still got to live by faith no matter what. But where does that faith carry you, right? So I think you got to really be comfortable in your strategy and stay with it, whatever it is, but understand that there's always, the risk and return. I mean, that's part of any investment or any strategy really in life is risk and return. I mean, that's why we use the sentiments of faith, right? And so, one of the things I like that second video that you sent, Ben, where you were talking about the three different options and how you look at it. And that's just a strategy. It's all speculative. I mean, no one has a crystal ball in terms of where things are going to go and how it happened. You asked the people in 2008 when we had the debacle in the financial depressed market came out of somewhat nowhere. Why? Because of the lying loans, the falsehood, the misrepresentation. So anything that's built on misrepresentation, eventually it's going to fall and it falls hard. I mean, that's just the nature of how things are set up. And that's why you got to really, like what Ben's doing, he's listening to what's going on in the rooms of those that may have access to truth. But if you don't have truth, it's amazing how you can invest in a lie and that lie can disrupt more than what you put in from that standpoint. So I just say that from a prudent standpoint and looking at things globally and looking at things from a cyclical standpoint of how things work in cycle, You want to be on the right end of the curve when those adjustment comes because they have to happen. The thing that I think that what you said, Ben, and what you're saying, Rod, is the confidence that the public have in our financial system in the way it's operated. That's the only thing that's holding it up. But we don't even know how true that is because it seems to be a disconnect in real life versus the ivory tower life that has been going on. And so I, as a regulator, I get some access to what's going on inside. I can't share that, obviously, but I will say that this is a time to be very precarious. It's a time to, or not precarious, to be a time of being prudent. It's a time to be diligent, doing your due diligence, and then being comfortable with the decisions you make, regardless of how it turned out, because it's there's just a lot of noise that are going on, and people are gambling. They're not making prudent investment. They're just gambling, and that is what's holding this bubble together to some degree, as my economist tells me, sort of behind the scene. And so we're trying to be ahead of that and try to institute, but our hands are tied to some degree because of the deregulation. All the ones who have the checks and balances, they're not there. They've been pretty much stronghold into not being able to add the balance, the prudence, the check it, right? Check the numbers and see what it is. And so you got to realize what kind of environment you're operating in too. It's not business as usual. It's not investments as usual. It's actually not even returns as usual. One is there's a lack of checks and balances for truth. And I think that's some sentiments that I would add to the conversation. Thank you.
Gentlemen, long time no see. How we doing? Here's my take. I've been selling. I'm continuing to sell. Now, mind you, my situation is a little different. I'm retired. I have two retirements, and plus, I'm still working a full-time job. And the reason why I'm selling is because if you look at the effect of that war has on the market, just Google that, and then look at this new virus that's coming. Let's not be naive to the point where we think that because these numbers, the market doesn't show it. I think to Jeff's point, it's circular and things do come in cycles. So look at the effects of war that a war has on things, and they're saying that this is a new economy, so to speak. So if there's a new economy, you have to get rid of the old economy. And my thought process is that to get rid of the old, you have to kind of like kill it off. So that's where I am. Again, I'm selling things. I won't sell Apple. I won't sell the top seven, whatever you call them. Not that I'm in all of them. I'm just in the ETF with most of them. But yeah, I'm definitely getting as small as possible and working on my cost of living. So when the market does reset itself, then I'll have some buying power. And I'll also start thinking about things of not so much as buying real estate, but building real estate. Um, and looking into things, markets where materials, solar, and energy, if you're gonna stay in the market. I think cash is king. I'm a true Warren Buffett, Buffyette, or whatever you want to call him, Buffstonian, and he's really investing in this one currency. I mean, not currency. I'm sorry. This one stock. Well, not just this one stock. There's a stock that's kind of like Cash App. Till I wish I knew the name of it off the top. I'll text to you, Rod and Ben. I'll text. You guys can text to the group. It's a money sharing for Spanish countries. It's like Cash App for or Zelle for those countries. He's heavily into that. And if he's selling, I'm selling. He's been doing it for a long time. So, and there's also a magazine that I would think you guys should just take a look into. It's called Kiplinger. A friend of mine just recently told me about it, and he does very well. So that's just where I'm at with mine. Again, my situation is different. So that's why I'm, if you guys care to know my opinion is. Peace, fellas.
Right on, man. Thank you.
I like the idea of scaling down too. Like in times like this, what happens? People usually get laid off. Opportunity, like even if you got your own business, sales start to come a little bit lower. You know what I mean? So it's never a bad idea to have your expenses tightened up and a lot of the fat cut early, so that you've got a nice savings as well as not too many expenses to outlast or get through whatever bad time may be upon us at some point. Might not be today, might not be tomorrow, but it will be at some point.
Yep, I agree.
Great call.
So did anybody want to add anything else? We are on the hour or a little bit past, but I didn't know if anybody else wanted to share anything.
Really quickly too, I didn't forget you guys about those banks that I was gonna give you guys, shoot those emails to you. I mean those texts. I'm gonna send that to you too. Rod, remind me, I'm gonna send it to you either today or tomorrow, so you can send it out to the group text. Last
Okay.
time I was on the call, I talked about those banks. So I'll do that also.
Okay.
Any other last minute thoughts, comments? As they say in the old church, if all hearts and minds are clear. All right. Well, take silence is golden, man. Anybody want to take us home in prayer?
Hold on, let me stop the recording real fast. Oh, you got the mic, Ben. I mean, you're the host.
Oh, I'll send it back.
Okay.
Well, I can't do nothing.
Oh, you can't make me the host?
Maybe I can. I just don't know.
Click on, if you'll go to the blue button in my on my picture there, I think it'll allow you to make me the host. I think that's how I made you the host.
Gotcha.
Okay. Got it. I lost the recording button, man. Not down there anymore. Hold on. Oh, there it is. Okay.